Hi, welcome to Search for Yields, a weekly newsletter from INR Bonds. I am Arjun Patsati. And with the Russian-Ukraine crisis hitting the markets in India and globally, in this edition, we talk about the impact of this crisis on your fixed income investments and portfolios. With more now, you will find that most of the commentary is largely what will happen to equity markets. But given INR Bonds is a bond-centric digital platform where we showcase bonds for investors to invest in the best bonds for their portfolios through our Quick Invest by INR Bonds app available for download on iOS and Android devices, where you just download the app, check the bonds most suitable for you, and invest in a seamless process. All it takes is about a few minutes for you to make your bond investments. Coming back to the impact of the crisis on your fixed income portfolios, clearly, the first impact, as we all seen and know and we track closely, is the market volatility. So the Sensex and FTR, the Indian equities are down sharply, which is expected given that risk aversion is there. But over and above that, you have the threat of foreign portfolio investors taking money out of emerging markets, given that there could be an impact on currency. And with oil prices also touching $100 per barrel, which is not seen for the last many years, then this has a threat on India's imports bill. A trade deficit could increase, and the rupee could also come under pressure. And all this can keep the rupee very volatile. And this has a direct impact on bonds as well. So with the rupee falling, if it falls, then RBI will have to step in and try to protect the rupee. And one of the ways RBI has been doing for some time is to raise interest rates. But and also they might intervene in the foreign markets, forex markets, to sell dollars to keep the rupee stable. But it has its impact. And this time around, we think that RBI will not raise interest rates, as they have to make sure that the economy is protected and the interest rates are still low for borrowers. But with inflation very high due to higher commodity prices and oil prices and global inflation anyway staying high, then and also the government announcing a record borrowing for the next fiscal year, where the supply is going to be excessive from the government and states, then this clearly is going to impact negatively on government bond yields, and yields are going to rise. So when government bond yields rises, all other yields also tend to rise, which is mostly at the highest safety level, which is the AAA yields and other highest safety bonds. And so with low returns, it's not with RBI keeping interest rates at record lows and not taking it up to prevent any kind of rupee volatility. And along with the high rising government bond yields due to borrowing and inflation, investors have a tricky time to invest. And so they need to make sure that they are invested in the right products. So the best way to navigate this kind of a market is to invest in very short maturity investments. Even if you take in a bit of less returns, it's okay. But if you can identify a few investments which can give you higher returns, but with very short maturities, then investors will stay protected. And once this crisis has settled down, then RBI can start to normalize, and then interest rates can go up. And when they go up, then the short maturity investments will mature, and investors can reinvest at higher levels of interest rates, and the returns will be higher once the whole affair settles down. We don't know when it will happen, but this does look like I don't want to comment on the crisis itself because that takes on a different hue. And but the impact clearly is what you need to do is stay safe on your fixed income as well. Government bonds are not high duration, long duration bonds are not necessarily government bonds are not necessarily safe given that interest rates are going to rise. And so the best safety factor is short maturity bonds or short maturity fixed income investments, which may give you lower returns, but or some of them may give you decent returns if you know what to buy, invest in, and then you can actually navigate this whole Russia-Ukraine crisis. But yes, tough time for investors, and do download our QuickInvest Buy Bonds app, where there are a couple of few bonds that can help you navigate this crisis. And also, do not forget to subscribe to our YouTube channel if you've not done so already, and to hit the like button. Thank you.